Yo, what's going on, guys? It's back, and today we got a brand new video. This time going to be talking about how to invest your first dollars into the market if you're a beginner, where to invest it, how to manage your funds going into the market, and what to stay away from so that you don't make the same mistakes that other people have made, so you can learn from it. So learn from, like me, I had to go through learning this and lost money and then figure out ways to make the money back without putting more into the market. It was a great learning experience. I think everybody should go through that, but you don't have to if you just listen to what I have to say, and you can learn a little bit on how to invest. So first off, you're going to need to get a brokerage account. You can get one pretty much any major bank might offer one, but I got an offer for you guys. If you sign up for Robinhood, in the link in the description there will be a link to one of my links, and if you sign up through that link you will get a free stock up to $500 that you can get for free just for signing up. And those stocks include things like Apple, Facebook, Microsoft, GE, Ford, all those stocks. Obviously some higher than others, but it is a valued up to $500 stock. Now, after you've picked your brokerage and hopefully signed up for Robinhood, you will be able to start putting money in and start putting money into the market and making your money work for you so you don't have to work for your money. Now, there are different ways you can go about trading or investing, and that's the first thing we're going to cover. Do you want to be a trader or do you want to be an investor? Because they're two very different lifestyles in the market. You're going to have to do very different things being a trader as compared to being an investor. They're very different in the market. So if you choose to be a trader, I haven't done too much trading. I'm just recently kind of toying around with trading with a little bit of money to see how it goes. But I'm more heavily invested in looking into the future. But if you do trading, you're going to have to look through different companies. Start learning how to read the charts, which you're really gonna have to look into. Go on YouTube and go searching through how to read stock charts, where to predict stock charts. The reason I don't do a ton of trading is pretty much because I see it a lot more as a gamble, and I don't like to gamble in the market or gamble with my money, so that's why I'm more into investing. But you can make a lot of money trading. I feel like there's a lot of luck involved in trading. There's still luck in investing, like being an investor, but being a trader, I feel like there's more luck involved, and that's just something you're gonna have to weigh if you want to be, that type of person. Trading is very short-minded or short-sighted. It's a lot about making money now and getting the profits now today, whereas investing is more about getting the profits later and making money along the way, riding the waves, constantly buying in, doing stuff like that, which we're all going to cover in this video. But that is basically the difference, and I'm going to cover investing and being an investor. So when you are an investor, there are different strategies you're going to have to decide whether or not you want to do, which one you're going to go about. I would suggest sticking to one, and kind of hammering down and focusing on that one until you grow your portfolio to a size where you can shift to another one or start doing another one. But I would stick to one off the rip. And you would have things like Dividend Investor, Growth Investor, Index Fund Investor. These types of things are three right off the top of my head I can name. And the difference between the three is the way that the money comes in and the way that you kind of secure your money. So basically, with a dividend investor, you're going to focus more on the dividends, on companies paying you to hold their stock, instead of focusing on the company's stock price that you're in going up for you to make money. So the price can go down a little bit, obviously not too much, because it will start giving you losses based on the dividends. But if the stock price goes down, you still get paid to hold that stock at about the same dollar that you would get. It's the same percentage based off of money you have in there, and once you get that strategy down, it's basically you buy stocks that are reputable, that have constantly paid their dividends, have good dividends. You don't want to get into ones that are too risky, that pay big dividends, because dividends are a way that companies pay stockholders and shareholders for holding their shares, obviously. So if they pay a large dividend, it might look good, but dividends aren't guaranteed and they don't have to stay at a rate that it is at. It can be cut at any time. It can be taken away at any time. So there's also a little bit of risk you run doing this strategy, which is why you look more into companies that have been around for 50 years, 100 years, that have never cut their dividends and constantly paid them out. Now, with a growth investor, this would be somebody focused more on the growth of the stock price instead of, getting money passively from the companies. This is more able to make a lot more money, in my opinion, with a lot less money. So to make a bunch of money in dividends, you're going to need a lot of money in stocks to be able to get paid that stuff, to, I guess live on and stuff, but get those profits. But with growth, you can put in less money and the stock price shoots up. You make a whole lot more money than if you were getting paid dividends. So that's a big thing that I'm in, is this growth market. I do have stocks that pay me dividends, and you can have both when you look into blue chip stocks, like things like Apple, Microsoft, Disney, McDonald's, these types of things. McDonald's is actually a dividend stock that I own, but it's still, it's like weird territory because of what's going on right now. But the blue chip stocks are the things that you can focus on. They're the most secure, that will, give you a return on your investment pretty heavily, and every year you'll see, an uptick in the money you have in your account. You'll get a return. And when you're doing this type of strategy, the thing that I would do and focus on is, obviously you have to diversify yourself a little bit, because you're going to be picking your own stocks in this, where you obviously don't want to be too heavily in the tech sector, where if the tech sector goes down or has a fall, then you're going to lose the majority of your money, and then the other sectors go up and you don't get to ride that wave. So you need to find that balance of tech stocks, fast food stocks, entertainment stocks, these types of sectors, so that you're not heavily in one. However, if you are heavily in one, then you're just running yourself more risk, because if it goes up, you're going to make a lot of money, but if it goes down, you're going to lose a lot of money. So you just got to manage your own risk at that point. But I would say diversify a lot more than, a couple companies in the same sector. I would get probably, if you like the tech sector, it is very, very good for growth, and it had tremendous gains in many years. So if you want to have a bunch of tech stocks like Apple, Microsoft, Amazon, then you hold those. And then if you want to have a couple, like we said, McDonald's and Disney, those are outside the tech sector, so that will hemorrhage your bet, a little bit, so that you can enjoy, if these sectors go up, the fast food or entertainment, at least you're involved in it a little bit, so that you can enjoy it somewhat. And for the final investing strategy that you can go about is the index fund investor. It is super passive and easy. You don't have to manage any stocks like a growth one where you pick your own stocks. You would do the index one is basically, I would pick a broad index fund like VTI or VOO, something with an S&P 500, or something that tracks the whole market, and you can get one that tracks like an international market. So that will leverage your money better, so that it's more diverse. It's like, I know VTI as an index fund is a total stock market index fund, and so if you buy into that one fund, it's like $150 something right now. And if you get one share of that money, that $150+ is spread out, but amongst 3,000 companies. So that's where your diversity comes in on the funds. So you don't have to do it yourself or worry about it yourself. And the funds pay a dividend, so you will get paid for holding the stocks as well, which is a really nice thing to have. So not only are you diversified, but you also get paid to hold it. So I personally have a combination of the index funds and my own growth stocks that I picked that happen to pay dividends, but I don't focus on the dividends sector, or like the dividends that companies pay. I focus on where I see companies in 5 years or 10 years. That's where you got to look for the future for investing. And once you pick your strategy, basically what you got to do is obviously run down your own finances, figure out your expenses for every month and how much you make every month, and then decide on an amount a flat amount that you're gonna try and do every single month, because you're gonna wanna be consistent with investing. That's the best way to grow your money and make your money go to work, is basically pick, let's say $100 a month. If you take $100 a month and put it in the market every month, put it into stocks you picked or put it in index funds, and you can just continue doing that every month. You don't have to time the market. That's not gonna help you. You can always remember, time in the market always beats timing the market. So that's very important for some people to realize, that you got to spend time in the market and it'll pay off, especially when you're just getting started. That ability to lose money is super high, because obviously whatever you buy in at, if it goes down, you're going to lose money. To whereas if you're, a year in and you've continued buying in and stuff and diversified your companies, that you could be making money on some, losing money on others, and still be making money overall. So you just got to ride it out and go into the long term and pick that amount a month and just put it in the market, make it go to work. So just always buy whenever you put money in. You don't have to see if it's a green day, red day, good time to buy, bad time to buy. You can just buy, and as long as it's consistent, that's the best strategy to make money in the long term. So you don't have to look at a chart and see if the stock price is up too high or is going up. Should you buy in? Do you think you should wait? You can just put it in. And the short term, you might see a loss, but the long term is where you're looking into to see that gain. And if you see the loss and next month you put $100 in, you buy your average down. So it's going to be easier to start making money on the stock, because when you buy it at a lower price than you originally bought it, your break even comes down. And then if it happens again, it comes down even further. And then next month, if it booms up, you don't need the stock price to go back to originally where you bought it to make money. It'll go to an average, and that'll be your break even. It shows you right on Robinhood your average stock cost or your average price that you bought in. And once you break through that, it's going to start making money for you. So that's what you got to think of. So guys, let me know what you think of this video, of what your investing strategies might be if you are involved in the market. I'd love to hear. I'd love to hear, different thoughts on different types of strategies and how you guys go about the market. And we can all teach each other something and have a conversation in the comments. I love seeing different points of view of everyone talking about stocks and everything. Let me know what you thought of these strategies, which one you like the best or don't like to use, or you've seen other people doing and you want to try and replicate, and we can start a conversation in the comments. But as always, guys, don't forget to smash that like button, smash the subscribe button. We are on the path to 1,000 subscribers, and I'll see you guys in my next video.